Again, not that much price movement today. We've got the Dow down 90, Nasdaq's down 4. That's it. Some reading, but not much. David Strazewski joins me now. All right, David, you know I read your stuff, and you think stagflation is coming. Make your case.
Yes, sir. Well, the Federal Reserve over the last 40 years has just been reducing interest rates in a meaningful way. So we hit that 40-year mark in September last year. Obviously, we're seeing inflation happen as a result of the COVID spending that trillions of dollars went into the American people. We got overheated. And so every M&A deal got done. Every IPO got done. We propped up the stock market. We propped up the crypto markets. We propped up the housing market. And I believe that this overheated state is going to lead to this stagflation where we have a lower GDP and more unemployment ahead of us.
So a long-term recession, you think?
Well, we measure the world in 3 different indicators, short-term, a mid-term, and a long-term. Kind of like a watch has an hour hand, a minute hand, and a second hand. So our hour hand is negative. Obviously, the 2 negative GDPs in a row give us, what used to be the definition of recession. But there's others that go into this as well. On the short term, we see a bull market. I vote it goes up forever. Midterm, we're looking negative right now. And so I think after the midterms, we're probably going to be seeing that cycle begin to dip down if we don't sooner than that.
So I'm not quite sure what you're really saying here. I'm inclined to jump on board with this rally, buy some more Microsoft or big tech or whatever, and hold it well into the next few years. What do you think of that as a strategy?
Well, I think that there are certain assets that we need to have as long-term investments. And so Microsoft is a home team favorite for us here in the greater Seattle area. And we use it a lot. The point is that we also need to be patient in this market cycle. We need to understand that we're not doing supply-side economics right now. So that's what got us out of the 70s. We're doing exactly the opposite of that now with the new wet blanket of, IRS agents showing up at 87,000 at a time. This is not necessarily the recipe that we see for the best long-term.
You're just not really, you're not really gung-ho for stocks at this moment, are you? You're very, very caught. I'm reading between the lines. You're not happy with putting lots of fresh money in the market at this point, are you?
No, I'm not. And frankly, we need to avoid the bond market as well, because as we see these interest rates rise, and I'm actually more bearish on bonds, because as interest rates rise, the value of our bonds go down relative to net present value. Of course, if the 10-year treasury, which you got up on the screen, rises, that significantly impacts those large companies like Microsoft out there. So we need to have real hedge strategies here today. And a lot of America has a difficult time figuring out where to go, what to do. So again, be patient. I think the right allocations and the right names make sense. And then we need to be finding alternatives to bonds here today that can give us the ability to ride bulls and tame bears.
Real fast, I'll tell you what I got. I got Microsoft, I got Blackstone, and I got a lot of money in a short-term bond fund that pays me about 2%. Where am I going wrong?
I don't think that you're going wrong there. You may want to pick a few different names. There's names that have been beat up in a significant way. We're looking for cash flows right now. I do like how you're going for individual allocations, though, over just doing indexes. But I like the cash because I think we're going to have opportunities to be nibbling back in here as time continues to go forward.
But not yet. All right, David, thank you, sir. We'll see you again soon.